Right. Nobody could have seen this one coming. At least not the economists who are supposed to see this one coming. Canadian inflation, which is measured by CPI, just came in at 4.4%, and economists were expecting it to come in at 4.1%. This was an unexpected increase based on what most economists were forecasting for. This is the first acceleration in the cost of living that we've seen since June of 2022, when Canada's inflation rate hit a 40-year record of 8.1%. Food and gas were a big part of why inflation is continuing to rise, but there was a bigger cost. Mortgage costs saw the biggest growth out of all the components of inflation. They were up 28.5%. Rents were up 6.1%, which also pushed the headline costs. You might have noticed a little bit of sarcasm at the beginning of this video. That's because perhaps the powers that be should have seen this coming, given that we know that mortgage costs are a significant contributor to CPI and that we know that they're up significantly year over year, especially given that the two biggest rate hikes from the Bank of Canada happened this time last year in May and June. So once we get over that big hump, it would be reasonable to expect that the mortgage portion of inflation will start subsiding a little bit. Whether or not that means inflation comes down is really up to what happens with gas prices and what continues to happen with food costs. With all that part being said, there is an ongoing cost that happens as well. And the Bank of Canada acknowledged this recently in their financial system review, which is available on the Bank of Canada website, especially in chart number 12. To date, only 1/3 of mortgage holders have already felt the increase of mortgage costs. So that major piece that's showing up in CPI or in inflation is actually only happening within 1/3 of the market. But by 2026, 100% of those mortgages will have had to have absorbed that new increased borrowing costs, unless interest rates come down substantially by then. And the majority of these 5-year mortgage terms renew in 2025 and 2026. For context, people who would be renewing in 2025 or 2026 would have got mortgages at rates in the 2s or 3s, and they'll now be renewing, unless something changes, they'll be renewing at a 5 or a 6% interest rate. It's a huge increase in borrowing costs. The Bank of Canada goes on to talk about how higher borrowing costs are creating financial stress. We're starting to see some cracks showing in the Canadian economy. They're stating that we're vulnerable to a recession and unemployment that could further depress house prices and increase loan defaults if that happens. And elevated stress from these lending costs and on households and from mortgage defaults could cause liquidity to contract in the banking system. This comes from the Bank of Canada, and it's a little bit jargony. And so to explain that one like you're 5, this means banks would want to lend less money because there's too much risk in the market. And if you start to see that contraction or decrease in how much money banks are lending because things are getting worse, then it'll make things even more bad. Because Canadians use debt to solve problems. We need more money to keep the financial system going. CMHC even jumped into this sort of doomsday-ish conversation on Twitter recently. They stated that Canadian household debt has been rising for years and now the highest among G7 countries. In 2021, household debt exceeded the size of the economy. So there was more debt in the economy than the entire size of the Canadian economy in 2021. With 3/4 of that debt, 75% of that debt, coming from mortgages. So the Canadian economy is heavily exposed to real estate, and it's heavily exposed to real estate through debt. So the idea would be that the major impact on inflation could pass us by within a couple of months, given that the biggest rate hikes were in May and June of 2022. But the Bank of Canada is literally at a point where we're fighting inflation with inflation. And I know I've said that a couple of times on social media because it sounds, peppy and people like it. Is peppy a good word? I don't know. It sounds funny, it's like fighting fire with fire, but it actually works. And I'm going to explain why. People are spending more money on mortgages, which means that they have less money to spend on other stuff. And other stuff drives the economy. It helps the economy grow. People spending money in businesses and whatever, whereas injecting money into debt, a sunk cost in a non-productive asset. Real estate is a non-productive asset. It's not like a piece of heavy equipment that is productive or a farm that is productive. And so this money being taken out of the economy and into consumers' mortgages is a contraction in the economy. A contracting economy is called an economy in recession. Sorry to drop that word on here. I know it's a bit of a swear word around here in the Canadian economy, but it seems to be more and more of a conversation among government agencies who are controlling the narrative. And recession has a 100% success rate of bringing inflation down to the neutral range. This is why Benjamin Tao, chief economist of CIBC, says that if the Bank of Canada has to choose between inflation and a recession, they will choose a recession every single time. And I've been saying this on this channel a lot. I've been saying it on the podcast a lot. I've been saying it on all of my social media a lot. And now we're finally getting to that path where that's the decision that needs to be made by the Bank of Canada. And they'll do whatever they can to remove inflation, even if it means sustaining or creating more pain that we're seeing happening in the Canadian economy that they've identified in this financial system review. So that's a lot of information. It's a lot of relatively negative information. But from my perspective, this is one of those moments where things have to get worse before they get better. And we need to have a little bit of a culling of the herd, a little bit of a healing moment, in a little bit of a Darwinistic phenomena to happen in the Canadian economy to take out some of these bad actors and bad decisions that were propped up by a financial system where interest rates were in decline for the better part of 40 years. So what do you think? Is our insane debt situation a blessing or a curse? Do you think that this is going to make it easier for us to get it over with quickly because we're more sensitive to these interest rate increases that the Bank of Canada is doing? Or do you think that this means that we're going to have a long, drawn-out downturn, almost like a lost decade, like what happened in Japan in the 1990s? I'd love to hear your thoughts below. I'd love to have good arguments in the comments. Leave me some thoughtful feedback, and I appreciate you watching this video. Please like, subscribe, and leave me a comment.